Nick, good to see you. Today, we're going to talk through market volatility and when you should have a plan, when you need to react, and whether keeping your head in the sand is ever a good idea, because that's generally what I do. So
Never.
I want to talk through, some financial headlines. And that being said, we are recording this in late March, but of course, the market has been very volatile. Let's take a look at the S&P right now. This is the 1-month performance, Nick. So as we can see here, a lot of red on the board. But this is mainly driven by what's known as the Magnificent Seven. You and I have talked before about the concentration risk we've seen in the S&P right now. So is this alarming right now?
Well, when you see that, you see a lot of these big boxes, right?
Yeah.
Big red boxes. And you see these little small ones and you're trying to figure out, okay, what's the deal here? And if you look at all those, we call these, like you were saying, the Magnificent Seven. It's your Amazon, your Apples, your Microsofts, your Nvidia, your Google, your Meta, and those companies, your big tech companies. And if you look, those are the ones that are down the most, but those are playing such a big weight on the indexes that when those go down, just even if because they're smaller companies or bigger companies, but even if there's just a few of them, it pushes the whole thing around.
Right.
So you got some things in here that are green. You have Berkshire Hathaway, you have United Healthcare, you have Exxon Mobil. So you have some that are there, but it's these bigger ones that's pushing these indexes around. And if you look at a lot of these exchange traded funds that are out there, a lot of these mutual funds, they are almost very heavyweight. In these Magnificent Seven, these Amazon, these Apples, these Microsoft, Google, Nvidia, and all that. And actually, I did a little bit of research because I knew we were going to talk about this. So I did a little recon, and I went on Investors Business Daily, and I just wanted to see how much of the NASDAQ index, because you hear it out on the news. When you turn on the news, you hear about, the Dow Jones and the S&P 500, and you hear about NASDAQ. And I just kind of was curious about how much these bigger companies play as far as a percentage of that index. And if we look at the NASDAQ index, Apple makes up 9.4% of it. Microsoft makes up 8.3%. Nvidia pulls up 8.2% of it. Amazon 6%. Google, Alphabet 5.7%. Meta, Facebook 4.3%. And then you have Tesla at 2.3%. That pulls it up. Just those companies is over 42% of that one index, which is well over, it's like 100 companies. Of all those 100 companies, those ones I rattled off pulls up 42%. So if any of those companies are having a bad day, and they're all in the tech. So if they have a bad day, that affects pretty much everything. And we see that a lot, and I'll come back to this maybe later on, is that when interest rates go up, it definitely affects the tech companies oftentimes the most.
Right. But interest rates aren't necessarily going up right now. They're holding steady.
Well, they haven't gone down like they said they were going to.
Right.
And so that was the Fed just, has every time this keeps coming out. And the idea was they were supposed to drop it a couple times already, and they still haven't this year. Yeah. And they're saying, well, we might not even do that until the end of this year, because inflation is still stubbornly high. So we're going to keep interest rates higher. And there's a whole slew of reasons why that can be a problem. I mean, for instance, we did an article on this. So I just printed off the article, and I thought this would be a good thing to talk about, is what happens when the Fed raises interest rates and keeps them high. So number one, you're going to have higher borrowing costs. Mortgage rates are high. So what happens is real estate slows down because people can't get mortgages at the rate that they want. They're not 3% anymore. It's 7%. Consumers borrow less because it costs too much to borrow. We're starting to see that with cars. It's costing too much to get car loans, so people aren't getting cars. The second thing, slower economic growth, stock market volatility. That's another thing that happens when the Fed doesn't cut rates, when they keep them artificial, when they raise them to slow things down, because that's what they're doing. When they raise interest rates, they're trying to slow things down. But when they keep them at that level, that's when the problem starts. So if we look at the stock market volatility, growth stocks, particularly tech, like I mentioned, another thing that I talked about in this article was impact on jobs and wages, because what happens, look at it as companies have what they call cash runway. And what that means is a company will, when they're doing good, raise cash so that if things don't turn out so good, they can use their cash runway to help them get by. And that's how that works. Well, eventually, when interest rates are so high and a company can't go borrow money, They go into their cash reserves, into their cash runway. And when that runs out, that's when really bad things happen, like layoffs. I talked to a lady yesterday. It works for a Fortune 500 company. She said, I've seen things before, but I'm seeing a lot worse things now. And the layoffs are just scary.
Right, right.
And so you have this issue as a result of these interest rates being stubbornly high. I don't know what's going to happen towards the end of the year, if they're actually going to cut them. They should. Statistics are showing there's a 65% chance that they're going to cut rates, but that's not 100%.
Yeah, well, with tariffs, here and on the way, which could lead to greater inflation, we'll have to see. But Nick, you bring up so many good points. I think a lot of people, as we know, consumer sentiment is very low right now, are wondering, all right, well, the conventional advice is stick to your plan, right? Or even keep
If you have a
buying
plan
now.
Yeah,
But
if you had a plan.
if you had a plan.
Yeah.
So how are we supposed to react right now?
Well, and that's the thing is there's two rules I've always followed. I'm just going to mention one, rule of one. Every 1 year or so, there's a market correction. Okay. And we've gone back in time. I've gone back through like the 90s, the 80s, the 70s, the 60s, the 40s, and gone back and looked at how often a market actually drops. And you have this right here. This is what we use. We call these areas kill zones. But you'll see that every generally 18 to 24 months, the market has a pullback. Like in 2020, everybody's like, oh, it's a shocking thing that COVID happened. Well, if we look, that was right in that 18 to 24 month window from low to high when the market entered that kill zone and the market pulled back. And then it happened again in 2022. The market took off and then it slowed down and it pulled into this kill zone. And kill zone, don't look at that as like, oh my gosh, that's awful. That just means that's the time when the market's taking a breather. It took a breather in 2020. It took a breather in 2022. But here's what happened. In 2024, it entered that zone during the 2024 year, but we didn't have that pullback. So now we're seeing this pullback, and this pullback is kind of long overdue because it generally happens every 18 to 24 months is when we see something like this. The problem that I find, to answer your question, is most people plan for only good times. They don't anticipate that there ever is going to be a bad time. So when it happens, it shocks them like, oh my gosh, how'd this happen? The market's actually going down. Well, hold on. It happens quite frequently. The market ebbs and flows. It cycles. And so you've got to plan for those cycles. And a lot of people, they don't. They over leverage. They put way too much money in when the market's at the peak. And then when the market starts going down is when they get scared and then they pull their money out and then they never get back in because they're at the wrong part of this cycle. So you just got to understand the markets kind of do this thing. This is a normal happenstance of what it does. You just got to have a plan that can withstand both good and sour markets.
Let's talk a little bit more about that, Nick.
Yes, the emotional investing cycle. How did I know that this would probably pop up at some point during this conversation? And you can see that it almost every cycle begins and ends with optimism. Isn't that interesting? So you start with optimism and then the market's rising. And usually when somebody is talking about how my buddy made money in the stock market, he's making money in this or that or everything else, that's that thrill and euphoria stage. So then what do? Hey, Joe's doing this, so I'm going to go do this too. And usually by then, the move is already done. And then you ride that wave down into panic and despondency and then skepticism, and you pull your money out. And then there's a number of people I've talked to, Aaron, that in 2008, when the market went down, got out, and still to this day have never been able to get back in just because they saw a 40 or 50% drop and never got back in. If you just studied this, you would understand that you just got to know that the markets go up, they come back, they go back up again. This is a cycle. It never goes straight down, but you still got to be able to live through it and adjust through it and not miss those days, those bigger days like you're showing here. Is when you're trying to time, it's time in the market that matters, not timing the market. And sometimes you do have to adjust because there's going to be times like if you have to adjust a portfolio. And what I mean by that is being fully invested doesn't necessarily mean what I buy today is the same thing I'm going to own 30 years from now. Because if that was the case, and I invested in vinyl records 30 years ago, I'd be in a really bad state right now.
They're coming back though.
Well, they're coming back as artwork thrown on a wall. and I have seen for Christmas, what was crazy is I did get a gift of an actual vinyl record player for Christmas, but it's so big. I mean, I thought, why do I want this thing? I've got a vinyl record player right here, right? So I'm not sure I'm going to use it. Point being is you've got these points in time where the market goes up and down. You just got to be able to adjust and adapt to it. And so that means that at times, if we think 30 years ago, tech was not a place to be. Now tech is becoming more of the forefront. So you're going to have to change your portfolio from time to time to mirror and mimic what the market is actually doing too.
Right. And it's so much more though than our traditional allocation of stocks and bonds.
Yeah, this is something that I've gone over for at least 5 years now. Maybe about 4 years ago. This is the traditional American portfolio. 85% of Americans have this portfolio. They call this balanced portfolio. 60% stocks, 40% bonds. The idea is when the stock side goes down, the bond side is supposed to go up to counter it. I've even had some people come into the office to tell me so much as to say that their 401ks have 40% of the money that's safe. And when I ask them what they mean by that, they're talking about the bond side, because for years and years and years, bonds have been pitched as the safe side of their investments. So the idea is when the stock market goes down 60%, those bonds should go up to counter that move. But if you actually look at what's happened here, I put some numbers. If we look at from 2021 to 2025, the S&P 500's up, the NASDAQ's up. And you might think, oh, that's pretty good. However, going back, it's those magnificent 7 stocks that's making those indexes look really good. You take those things out, those indexes aren't looking so good. Right. That's why I put the Russell 2000 there at the bottom. That's your middle American, smaller companies, okay? And if you look at that in the same time frame, those middle American, that's like what's under the hood. They're only down, those are down 7% in that same time frame. The safe side, the left side, the bond side from 2021 to 2025, look at that, down 38%. So in no way, shape, or form could you ever look at that and say that's safe.
Yeah, well, 2022 was a terrible year for bonds and stocks.
Exactly, right? The double whammy at the same time. Bonds still haven't recouped. But I think what's happening is, here's the lesson that we can learn, is that you need to adapt, you need to adjust, and you need to rebalance. But you need to understand what is safe and what is not safe. You can no longer look at a portfolio and say, I'm just going to use stocks and bonds, and that's all I'm going to use. There's so many other things that you need to use now, because now the market's changing. Bonds aren't what they used to. They don't react like we thought. They're very interest rate at risk. And so there's other alternative investments that people should be looking into. There's principal protected investments that people should be looking into. That way, if you have these alternative strategies or principal protected investments that you have, and the market tanks and goes down, maybe it affects some of the money over here, but it doesn't affect some of your other money over there. We talked about that in colors. Your green money is your protected money. Your red money is your money that's at risk. And so it makes sense to have that risk money that you can weather the storm and you can live through it when it's going up and down. But then over here on this side, have your protected money. Even Warren Buffett, if you look, Warren Buffett has been raising cash. Warren Buffett has been doing this for the last 6 months. He's been doing this so that if the market goes down, he doesn't have to go to his other holdings and pull any money out. He can live off of this stuff over here. And so he has a plan. If Warren Buffett, the Oracle of Omaha, if he's got a plan, then none of us should say we're too good to have one. We need to have one so we can live through these times and get through them, because this is going to happen very, very frequently. It's not like this is going to be the only time. It's going to happen, and we got to plan for that.
Right. A correction is certainly part of a healthy market, but making sure that you are not making those emotional decisions is also very important. Yeah. So Nick, if somebody wants to speak with you, either to get a second opinion on their plan or to get a plan, how can they get a hold of you?
Easiest place, group10financial.com. Go to our website. All the information is there, videos, podcasts, radio show, all sorts of information. High content is on there. But more importantly, especially during these times, getting a stress test done on your money so you
Right.
know how
Right.
much risk you have. I mean, you definitely don't want to find out that all of your money has the propensity to go down dramatically. Hopefully you have a portfolio where you can look at it and say, hey, you know what? It can weather this storm pretty good. And that's what you want. And if you don't have that, you need to get that before it gets too late, because who knows? This could be worse in 6 months than it is right now. It might be better. Who knows? I just know that a good plan is one that can weather those good times and bad times.
Yes, that has volatility built into it. Well said.
Yeah.
Nick, thank you so much for your time today.
Great being with you.